We will begin our study with a simple introduction to managerial accounting. As we begin, there are some learning objectives that we will cover in this chapter, and the first is simply what is managerial accounting and how do we use it? How does it differ from the financial accounting that you have studied in Accounting Principles 1? We'll look at the differences between servicing, merchandising, and manufacturing companies, service firms such as attorneys or accounting firms, merchandising companies such as retailers, and manufacturing companies such as those that are manufacturing the concrete beams that you see on the roadway. How do these companies differ in the managerial accounting that they maintain? We'll look at different costs. How do costs differ for those services, merchandising, and manufacturing companies? We'll also prepare an income statement, which you should be somewhat familiar with now, but we will also look at how we prepare a schedule of cost of goods manufactured. So how do we know what the total cost of manufacturing, our total inventory, and the per unit items in our inventory happen to be? Once we know the cost for manufacturing a certain item, we can determine what's going to move from our inventory in finished goods to cost of goods sold on the income statement when we sell that inventory. We'll also look at how we calculate cost for service-related and merchandising companies, which are a little different than someone who is actually manufacturing their own merchandise. So let's begin with simply looking at what is managerial accounting and how is it used in the world. And I think one of the first things that we should look at is a new vision. The Pathways Commission is a commission that supports accounting education, and they've come up with a new vision model to try to help students, entrepreneurs, and businesses in general to understand what truly goes on in the accounting profession. And as you can see in the example that we have here to your left, okay, if we were playing Pictionary, okay, who could figure out that this is the bean counter? Okay, so how many of you have ever heard the accountant named the bean counter? And what's important about this bean counter is every bean is either black or white. Okay, and we tend to think of accounting as black and white and sometimes dry and boring, but that is not the case. There are a lot of people-related critical thinking issues that come into the accounting arena. And so let's take a look at the second side of this model. Okay, so if we were to begin, let's see here, and look at what the Pathways Commission and the American Institute of Certified Public Accountants is telling us accounting is really about, we start at the very bottom of this. Let me end my screen here. We start at the very bottom of this presentation where we can see that accountants are instrumental in helping to create a prosperous society. Okay, we see that at the top of our screen. And so if you'll think about what's going on, our end result is up here in our prosperous society. Okay, but we're beginning at the bottom where accountants are very instrumental in getting to that prosperous society. So if we think about, we've got economic activity going on in the business world around us. So people are, as we just briefly mentioned earlier, we are either manufacturing products, we are buying products for resale, or we are providing services. And in managerial accounting, sometimes unlike financial accounting that you have just finished, there are shades of gray. Everything is not black and white as the bean counter on the left. All right, we do have shades of gray, and accountants have to be professional, competent, and ethical enough to be able to analyze these shades of gray, turn the amount of data use the data that we have coming into our organization, and through our processes, we use our judgment. Okay, and sometimes that judgment is critical thinking, not just black and white debits and credits, but critical thinking about what we do with this data, how we turn it into data that is useful information for decision making, as we see above. And we want organizations to be profitable, but we also want them to be efficient, and we want them to communicate. We want them to be beneficial to our community, and we also want them to be a good contributor to our environment. So there are lots of things that are taking place in an organization that involves an accountant making critical decisions from information that involves shades of gray, not just the black and white bean counter. Okay? So if we look at financial versus managerial accounting, we've studied that financial statements are used by investors, creditors, government authorities. On the other side, in managerial accounting, this is more about what's going on in our business day to day. And so we are planning on, for the day, for the month, for the quarter, for the year. And we have to manage that plan, compare what we actually thought should happen in our business with what actually did happen. And we're concerned about the cost benefit of our decisions. How did we turn that gray matter into information and decisions that helps us to make decisions that are cost beneficial to our organization? All right, so if we look at some of the differences between financial accounting versus managerial accounting, we see that the primary users are financial or investors, creditors, government authorities. And what we're concerned about here is they are potentially investing in our organization, and so they're trying to decide whether to buy our stock, or they're trying to decide whether to loan us money and what interest rate that's going to be. All right, and so we're focusing on, for the most part, whatever happened in 2017, your accountant is analyzing that and reporting on it in 2018, and your investors and creditors are relying on that information. So it's almost looking back. We are required, in financial accounting to follow GAAP. You've studied about this at this point. Generally accepted accounting principles. This is what determines what goes on a balance sheet versus what goes on the income statement, and when we can record revenue versus when we can record expenses. And there are the scope of information is that typically we're going to prepare financial statements at a minimum on an annual basis, but hopefully on a quarterly and even a monthly and weekly basis as needed. Now, when we look to the managerial side, notice we hit the internal aspect. All right, this is information that company managers and employees are using to make sure that the business is operating in a cost-beneficial way. And so we use this information every day in our organization, not just, what happened last year, how well did we perform? Now let's try to do it better next year. Every day we need to know how well we are performing. And we need that accountant to be taking the data that's coming through our organization and generating it in a useful form that we can use to make decisions every single day. And if you'll notice in managerial accounting, we are not required to follow GAAP. Now, when a manufacturing organization, service organization, merchandising organization prepares financial statements, they have to follow GAAP. But what we simply mean in managerial accounting is there are no golden rules. You acquire and manage and manipulate and utilize data in a way that makes good business sense for your organization. So the data that we use internally to make decisions is not following any particular accounting standard. We do have to be ethical in what we do, but we don't have any golden standards in managerial accounting. I can't tell you how often in my MBA classes when we work homework problems, my engineers come up with a different method for a solution than my bankers use, and the bankers come up with a different method than my liberal arts students will come up with. There isn't necessarily a right way to come up with the right answer. There are multiple right ways to come up with the answer. What method does your organization need, and what method makes most sense to those who, if you're reporting to superiors versus subordinates? And we are looking at detailed reports every day, not just annually or quarterly. When I was in manufacturing, I had a plant manager who would stand over my shoulder every day at 2:10 in the afternoon to get his scrap report. Okay, how efficient were we in manufacturing our product with as little and minimal amount of scrap as possible? Okay, this was a daily report that was generated. It was very important to the organization. That's managerial accounting. All right, so there's some difference in how financial and managerial accounting is used in our business organizations. And when we're looking at management accounting, we're trying to provide information, obviously, that's going to hold the manager responsible for the decisions that they make. And the decisions that they are making impact different stakeholders, such as customers, creditors, suppliers, investors. And we can see some of the detail here in this slide. Suppliers. These are people who are providing the raw materials that we need to manufacture our product, and they are not going to provide those supplies if we can't make timely payments. So we have to understand cash flows. What about our employees? All right, not only are they there for their pay, and we need to manage and pay an efficient hourly rate, and we need to be able to maintain and sustain qualified employees, but we also need to have a safe working environment that makes our employees want to be a part of what we're doing and to avoid downtime. We have customers. How do we decide which customers we sell to? And if we are selling to them on credit, we want to be sure that they will be able to financially pay for their products in the future. We have asset vendors. If we're purchasing property, plant, and equipment, we need to be able to pay them timely for those items. Investors and creditors. If we want people to invest in our organization, if we're publicly traded and we want people to buy our stock, then we need to be able to show these investors that we can provide a return on their investment. If we're loaning, the bank wants to know, can you repay your principal amount and can you pay the interest? And so we also impact society. Okay, we have to obey laws and guidelines and environmental and safety regulations. But we also need to be responsible to our community. So we'll talk about sustainability as well as we move through this portion of managerial accounting. And so we do see in today's economy somewhat of a shift toward more services, and we have a lot of global attention because of the internet and time-based competition. E-commerce allows us to sell to anyone, anywhere, at any time, basically. And so we have to be constantly managing and monitoring our inventory and our products. As we move toward just-in-time management, this is what we would call a demand push type of inventory. We're not going to manufacture it until we know that someone needs it, and we're going to manufacture it as soon as they need it and deliver it as soon as they need it. But if this is the case, we don't ever want to get caught without being able to get the product to our customer, and so we have to manufacture things as efficiently and in the most quality way that we possibly can. We'll talk more about this as we move forward. Enterprise resource planning systems simply mean we've got data integrated from, if we have companies across the country, across the nation, outside of the international borders, then we need to have access to the information from all of these organizations in one place, and enterprise resource planning helps us to do that expediently now. All right, so we think about the total quality management, as I mentioned, especially if we're following just-in-time inventory and just-in-time management. We will also see a phrase that you'll sometimes hear referred to as the triple bottom line. We're about generating profits in business. We want to be profitable for the owners, profitable for the stakeholders and the investors. Also, we need to be interested in the people that are working for us and our community, and what footprint are we leaving on our planet. And so we'll see some of these things in our ethical standards. And the Institute of Management Accountants does have an ethical professional practice standard that we should follow. And if you'll just look at some of the key items here, competence. Okay, you have to be able, if you're going to be in any type of business-related field, especially accounting, you're going to always continue learning. Notice what happens here. You will be continually developing knowledge and skills. Okay, so you're not finished when you finish this class. You're not finished when you finish this semester. You're not finished learning when you graduate from Union University. You have to work on continually developing the knowledge and skills in the profession that you're in. As accountants, we have access to a significant amount of confidential data. What do you do with that? All right. And so we have to understand when we can disclose information and when we can't. We have to do all that we do with integrity. As an accountant, we're considered to be a professional. And so we have to act that way in our business, in our personal life, in our social life, or we will not be respected in our profession. And we have to be credible. Okay. So can we communicate our information, as it says, fairly and objectively? Do we disclose everything that should be disclosed? Or are we a little shady in that gray area? And if we are, and people realize that we have worked with and been a part of a business that doesn't always follow the rules, we'll lose our credibility very quickly. All right, so this is the end of Learning Objective 1. I would encourage you to flip to the end of the chapter and see if you can successfully answer all the quick check questions that are there for Learning Objective 1.